Welcome to Money Talk with Michael. I'm Michael Eastham, president of Fellowship Financial Group. Money Talk with Michael is our weekly broadcast where we answer your questions about finance, investment, retirement, and all things related to money. Remember to send in your questions to the email listed in the description box below, and you might hear your question answered on the next Money Talk with Michael.
We are both 67 and will retire later this year, so we are well into our red zone of retirement, as you call it. We are not sure what we need to do to shift our investments around properly. Most of our accounts are in mutual funds, but we reduced risk by shifting about 60% of our investments to bond funds. Social Security and my pension cover our basic expenses, for now at least. How else can we assure that we won't run out of money before we run out of life?
All right, another great question. The thing you do need to remember is, and I'll refer back to our financial formula that I talk about quite often, TR equals I plus G. That means total return equals income plus growth. Now, always remember that when you're in the accumulation phase of life, mutual funds, common stocks, which are designed primarily for growth, remember, buy low, sell high, they're fine because you have your salary to back you up. When the stock market drops, you're not too happy about it, but you know that you don't need that money and you can let it grow. But when you reach that red zone of retirement, then you need to begin to take a look at the question, where's my income going to come from? Where is my salary replacement going to come from? And that's where you need to shift from the accumulation phase of life to the distribution phase of life. Not using growth instruments like mutual funds and even bond funds, but switching over to investments that are designed to pay interest and dividends with at least a portion of your money so that you feel confident that your income is secured. And even a lot of people have a misconception and a false sense of security about bond funds, for example. Because if a client of ours really likes to have some bonds in their mix, well, we typically will try to use individual bonds or bond-like instruments, because bonds have two important characteristics: a contract for interest, and you'll get your principal back when the bond matures as long as there's no default. With a bond fund, the definition of a bond fund is really the stock of a company that owns bonds. And you don't have any of those contracts. You don't have any of the predictable income sources like interest and dividends, and there's no maturity. So make sure that you understand the difference between investing for growth and investing for income, and that's probably the best advice that I could give you, at least at a high level. Thanks so much for watching. Tune in next Monday for another edition of Money Talk with Michael. And don't forget to send in your questions and check out our website at fellowshipfinancial.com and our social media platforms. And if you'd like, you can schedule a 15-minute complimentary call to get your specific questions answered. Everything you need is listed in the description box below.